The year has just begun, and almost everyone is asking the same question. Where does the market really go in 2026? Headlines are noisy: interest rates, inflation, geopolitics, AI hype, but the truth is, the biggest opportunities rarely appear when things feel comfortable. They show up when sentiment is split, when capital is still hiding on the sidelines, and when most investors are focused on the wrong parts of the market. In this video, we're not chasing hype. We're breaking down 3 high-conviction stocks positioned at the intersection of rate cuts, infrastructure demand, and long-term structural growth. These are not obvious picks, and that's exactly why they matter. Before naming a single company, let's talk about what's quietly changing beneath the surface. The US economy is entering a new phase of the cycle. Interest rates are expected to trend lower into 2026, credit conditions are stabilizing, and massive investment is flowing into energy, infrastructure, and AI-related build-outs. At the same time, valuations across small and mid-cap stocks remain historically attractive compared to mega-cap tech. This setup is rare. It's the kind of environment where patient investors are rewarded, not immediately, but decisively. The first major force shaping this opportunity is energy demand. Not oil headlines, not gas prices at the pump, but electricity. Data centers, AI workloads, cloud infrastructure, and electrification are pushing US power demand to levels utilities didn't plan for. New power generation, grid upgrades, and energy infrastructure approvals are accelerating. And here's the part most investors miss: the companies that benefit first are not always the ones producing energy, but the ones designing, engineering, and building the systems behind it. This brings us to the first high-conviction stock. Quanta Services, PWR, is a mid-cap infrastructure powerhouse operating behind the scenes of America's energy and utility expansion. Quanta designs and builds electric power transmission lines, renewable energy infrastructure, pipelines, and grid modernization projects. This company doesn't depend on consumer spending or short-term economic cycles. It depends on long-term contracts, regulatory approvals, and infrastructure necessity, and all 3 are lining up in its favor. From a valuation standpoint, Quanta trades at a premium compared to traditional industrials, but that premium is justified. The company has consistent revenue growth, strong free cash flow, and a growing backlog that provides multi-year visibility. If earnings continue growing in the mid-teens, which analysts expect, Quanta could see meaningful upside as infrastructure spending accelerates into 2026. The risk here is execution. Large projects carry cost overruns, but historically, Quanta has managed this risk better than peers. Upside comes from faster grid upgrades and AI-driven power demand pushing utilities to spend sooner, not later. Now let's shift from infrastructure to the part of the market most investors have written off too early: small-cap growth. For years, small-cap stocks have lagged large caps. But history shows this doesn't last forever. Small companies are more sensitive to interest rates, which hurts them when borrowing costs rise, but helps them disproportionately when rates fall. As financing conditions ease into 2026, earnings leverage returns. And within small caps, the real winners are companies with pricing power, brand strength, and global reach. That brings us to the second high-conviction stock. Crocs, CROX, may not look like a classic investment story at first glance, but that's what makes it interesting. Crocs has quietly built one of the strongest brand-driven business models in consumer discretionary. The company generates high margins, strong free cash flow, and has proven it can raise prices without killing demand. Despite this, the stock trades at a valuation far below the broader market and even below many slower-growing consumer names. From a valuation perspective, Crocs trades at a low double-digit earnings multiple, despite generating returns on capital that rival much larger brands. If consumer spending improves even modestly as interest rates decline, Crocs could see earnings re-accelerate. The risk is obvious: consumer weakness or fashion missteps. But the upside scenario is powerful. Multiple expansion combined with earnings growth could drive significant returns if sentiment shifts. In a rate cut environment, small-cap consumer leaders like this historically outperform. Now let's talk about the future of power, and the stock most directly positioned to benefit from the AI-driven energy surge. Renewable energy hasn't had an easy run recently. Policy uncertainty, higher rates, and capital-intensive projects pressured valuations. But structurally, demand has never been stronger. AI data centers don't care about narratives, they need reliable, scalable electricity. And utility-scale solar is becoming one of the fastest ways to deliver it. This leads us to the third high-conviction stock. First Solar, FSLR, stands apart from most renewable energy companies. Unlike many peers, First Solar focuses on utility-scale projects, not residential solar. It has long-term contracts, domestic manufacturing advantages, and a balance sheet strong enough to weather volatility. From a valuation standpoint, First Solar trades at a reasonable multiple relative to its growth outlook and backlog, especially considering its strategic importance to U.S. energy independence. The upside scenario here is tied directly to AI and grid expansion. If power demand continues accelerating and utilities prioritize scalable renewable projects, First Solar's backlog and pricing power could expand significantly into 2026 and beyond. The risks include policy changes and project delays, but compared to speculative clean energy plays, First Solar operates from a position of strength. So when you step back and look at the full picture, these three stocks tell a connected story. Infrastructure enabling energy growth. A small-cap consumer leader position for a rate-driven rebound. And a renewable energy company aligned with AI-driven power demand. None of these are hype trades. They're businesses with real cash flow, real demand, and catalysts that unfold over years, not weeks. The biggest mistake investors make during periods like this is waiting for certainty. Markets don't reward certainty, they price it in. The opportunity comes from understanding the trend before it becomes obvious. 2026 is shaping up to be one of those years where positioning matters more than prediction. If you found this breakdown valuable, make sure to like the video, subscribe to the channel, and comment 2026 if you want to follow up where I break down exact entry zones, valuation targets, and portfolio weighting for these ideas. This is Wealth Builder, and I'll see you in the next one. If this video helped you think smarter about money, hit like, subscribe, and share it with someone building wealth in 2026.